Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is Tuesday, April 25th. We have David Rosenberg and Ira Harris. David founded his own firm, Rosenberg Research, after being the chief economist and strategist at Gluskin Sheff. The firm offers extensive research and information services with a trial service that we will post a link up to on the website. He served also as chief economist for Merrill Lynch. And Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and also a stint most recently. Welcome, gentlemen.
Thank you.
Thanks for having us on.
Yeah, this is great. Thank you. This is always an honor to be on with David. Really.
Great, David. We'll begin with your macro view on the economy and the financial markets.
Who is that? Who are you? Oh,
Yeah, for David. Yeah.
Yeah. Sorry, you froze there for an instant.
Yeah. Yes, he did.
Yeah. Go ahead. Looking to get your macro view on the economy and the financial markets, David.
Sure. Well, I think that the view on the economy is that we continue to make this transition from the expansion that was fueled by the reopening trade and all the policy stimulus that we are morphing into a recession. I know that there's a lot of people that question that because they're focused on lagging indicators and contemporaneous indicators. But leading indicators are actually saying, and have been saying for the better part of the past 12 months, that the recession, if we had to time it, is actually starting this quarter. So the view is that unless you believe that interest rates don't matter, unless you believe the business cycle has been repealed, unless you believe that it's somehow different this time, the reality is that we're making this transition towards a recession, and the only question mark is how deep will it be given the circumstances surrounding the banking sector and the magnitude and the duration of any serious displacement or contraction on the credit side, especially in the regional banks, which have become such a critical part these past 10 years in terms of lending to the business sector. So that's the view. The view is that recession is starting. The Fed is over tightened. They'll be cutting rates sometime in the second half of the year, but it won't be in time to save the recession. But they will be cutting rates aggressively enough to promote the recovery in the next year. In terms of the markets, I think that whether you're taking a look at high yield or investment grade or the equity markets, they're not fully priced for the recession. I'd say that as far as the equity market's concerned, we're probably about halfway there in terms of pricing in the recession. The stock market, of course, in the past 15 months in this bear market, through the peaks and the valleys and the snakes and the ladders, has priced in something, but it hasn't priced in the full effects of what happens to the market multiple and what happens to earnings in a classic plain vanilla recession. My strongest conviction call is the long bond, and I think that we've seen the peak in rates. I think we've seen the peak in inflation. I understand the debate is how far will inflation go, the extent of the stickiness, but to me, what's more important is the direction, not the level. And so we've had peak credit, peak growth, peak rates, peak inflation, and I think that the best total return potential, as has been the case since last fall, is going to be at the long end of the yield curve.
Interesting insight. And your thoughts, Ira?
Well, always read David, and I understand, and I agree with him. I think the economy is slowing far more dramatically. I think financial conditions are tightening. And as I wrote last night, because I've been thinking about it, I think that when the central banks look at equity markets as their proxy for financial conditions, it's a huge mistake. And I think some of the mistake is borne by the Bank of Japan, because I think the Bank of Japan, by sticking to its YCC, well, of course, Kuroda raised it December 20th to 50 basis points, but now that Kuroda's out and Ueda is in, I think that it's a mistake from a global perspective what the Bank of Japan is doing, because it weakens the yen, and the weak yen creates the global carry trade, which leads to further support for global assets as Japanese investors, search high and low for some type of nominal yield outside of Japan. So it does, I think, and I've thought long and hard about this, it does give a false sense to other central banks. And I think that's the danger of what the Japanese are doing, because I think David's 100% right. Things are slowing, but some of the barometers have really been thrown off course. And I really think that, because they always talk about their coordination efforts, that they need to reassess what's going on in Japan and maybe put a little pressure on them, because it would take pressure off the other central banks, I think, to be as aggressive, because we're at 5% basically for Fed funds now. Now, 5% Fed funds, whatever the metric is here, we're getting close to a real yield on overnight money of 0, which is always stifling for various asset classes, especially equities. I can't tell you what the time is. I've seen it take 4 months. I've seen it take 2 months. I've seen it take 14 months. So we don't know that. But there are definitely certain things going on in the global financial system, I think, that needs to be watched. And with that, I then think David's scenario will play out.
Any thoughts on that, David, in terms of Japan, like the new leader of the Bank of Japan, if there's going to be a change in policy that could result in the yen strengthening, with potential repatriation of yen back to Japan, bolstering the markets there, or any idea like the effects of Japan assessing that on the global risk markets, like risk on, risk off?
Well, what's interesting is that everybody since the beginning of the year has been expecting more tweaks out of the BOJ, and they haven't happened. And the new leadership has actually sounded, I say, more on the dovish side. Japan has imported some of the global inflation in a relative standpoint. Their inflation rates are still incredibly low. If the U.S. had Japan's underlying and headline inflation rates, people would be talking about the Fed cutting. So I'm not so sure that the BOJ is going to have the opportunity to tighten policy, because I think that global inflation, and I say that even in the European context from a higher level, is going to be coming down. So I'd be very surprised if the new leadership, which is really not that much different in thought process from the old leadership, I don't think the BOJ, and even if they tweak policy, it'll be just like the last one. It'll be a one-off adjustment. So I don't think it's going to be creating an ongoing, yen appreciation situation. We had that, you can call it tape bombshell from Kuroda, on his way out a few months ago. And it had a very near term, dramatic impact, much like sometimes you get these initial shocks like we had in the UK last fall with those LDIs, and who talks about it anymore? So who's talking about the BOJ anymore? I don't think we're going to go into a sequence of BOJ tightening like we had in the States or in Canada or Australia or most of the rest of the world. So I would say that for me, it's not really top of mind.
Mhm. Interesting. Your thoughts, Ira? Do you see any change in like yield curve control
Well,
policy in Japan or yeah?
I just offered up in a pure theoretical concept because I look around, I go, what's going on here? Because, I look at the gold market and I don't look at the gold market as a crazy gold bug. It's not the way I look at it, but the gold is holding awfully well here as the central banks have raised rates and real yields get closer to zero. I'm a big believer that it's not inflation that drives gold. It's central bank credibility, of course, and what real yields are doing. So when real yields are negative by 2.5%, 3%, gold has, to me, a natural bid to it. But it's hard to believe that the gold is holding up here. And I always look at those outliers to say, what am I missing here? Why should this, I'm looking based on what I've viewed historically, gold should be under pressure and we should be testing, back to those 1580 to 1630 area and not, hovering up here at the $2,000 area. So there are certainly things that are missed that then gets me to, because David's view on the long end of the bond, in the way that I analyze markets, I go, well, do the central banks and fiscal policy, especially in the United States, warrant me purchasing US longer term assets? It's the question I ask myself regularly. Not, I've placed a lot of money and a lot of people who I give advice to into 1-year treasury bills because of course the yield's been far better in my estimation. So I'm shying away, but David, are you not worried at all about the poor policy coming out of the United States as far as fiscal? The monetary policy is definitely changing, but fiscal policy certainly doesn't seem to be changing as we head into our next election cycle.
Right. Well, I think that, when it comes to fiscal policy, and you could argue monetary policy or policy in general, the U.S. is still the best house in a bad neighborhood. So, when we're talking about currencies, it's always a relative game. Is fiscal policy any better in the Eurozone or in Japan? No, not really. I think that what's happened with gold is this. Last year people were saying to me, "What's wrong with gold? What's wrong with gold?" And I was saying, well, we're only looking at gold relative to US dollars because it's priced in US dollars. But if you looked at the gold price in almost every other currency, it was in a bull market. And of course, the Fed was raising rates far faster and higher than anybody else. And relative interest rate differentials for any pair trade in the currency markets, that's the dominating variable in the equation. So what's happened is that the markets now realize that the Fed is probably one and done. They'll probably hike in May, and then that's it. And the futures market are still priced for rate cuts by the end of the year. At the same time that you've got stubborn inflation in the UK and in continental Europe. So the ECB is going to still be raising rates long after the Fed is on hold. The Bank of England's probably the same. And when you look at the construction of the DXY, most of that is really sterling and the euro. So the US dollar this year has been in a bear market because of these relative shifts in monetary policy expectations. And so that's given a nice juice towards the gold price in US dollar terms. Of course, there's other things happening. There's concerns over, the debt ceiling. If you look historically at these debt ceiling fights, and even if they go to the last second and nail biting and we get some sort of resolution, which we always seem to have, it's like a Hollywood movie, gold tends to do well because it's inversely correlated to the level of certainty, or it's positively correlated to uncertainty. So you got the debt ceiling that's positive for gold because the hedge against uncertainty. You've got relative monetary policy shifts coming in the second half of the year that's going to cause the US dollar to go down. That's good news for gold. I think that I had mentioned real interest rates. Well, the Fed most likely, look, I think I think rational thought will lead you to the conclusion that the Fed is closer to the end of the tightening cycle than the beginning. And we know that tightening cycles are always followed. This isn't even a forecast. Rate hiking cycles are always followed by rate easing cycles. And the question is when, what's the trigger? We're closer to that than we are to March of 2022 when they started raising rates. So interest rates coming down is also very good news, lower real rates, very good news for the gold price. And on top of that, I think that we've got this ongoing shift amongst the major central banks of the world that they are moving increasingly into gold reserves. And you're also seeing, currency blocks doing more and more trading in renminbi and outside the US dollar. I'm getting more and more questions now than I have in quite a while about the US dollar's reserve status. If you saw on the weekend on Bloomberg, Larry Summers was interviewed, and that's all they talked about. And I think he was quite right that the US reserve currency status is not going to be challenged as long as for many, many years, if not decades. However, there's that perception. But to me, from the fundamentals, it's really what's going to happen with the US dollar. Commodities are priced in greenbacks, gold is priced in US dollars. And I think that the fundamental outlook for the US dollar all year long has been negative. It's not a collapse. It's just a natural cyclical bear market in the US dollar that probably has more legs to the downside. And if you're looking for one of the best hedges against that, it's going to be the gold price. I expect it's going to go quite a bit higher and probably go to new highs in the next 6 months.
Mm-hmm. Interesting analysis. Your thoughts, Ira? Do you see the US dollar weakening also through the end?
Yeah, I think David is right. And more importantly, totally right on the relative gold value. I mean, I look at the Chinese against the Chinese renminbi, gold's at all-time highs against the yen. So it's and that's the way I look at gold. I mean, the dollar is the ultimate end of it. And the interesting thing is the dollar has gone lower this year. The long end of the treasury market has actually rallied. The bonds have actually rallied, which, I mean, there's all these things flying in the face of what we've seen over the years. And I expect it because to me, the Fed and other central banks have broken the markets as far as, which used to be really good reactive and signaling sources. They're trying to get their legs. And I think we saw that in the Silicon Valley situation. It's like they couldn't sell assets. Why? Because they were carrying losses. So I think everything that we've learned and watched and hoped, if we took out forward guidance, I don't know how David really, I think he's probably not a big fan of forward guidance. It has directed certain actions that have really, I think, harmed the Fed overall, no matter what the academics may argue. I think it's harmed the Fed because it's painted them into corners at times where they would be better off letting the market be a signaling mechanism rather than, the 12 voters at any FOMC meeting.
I'll just weigh in on that. I think that, Ira and I think we agree most of the time, but I think we're batting like 5 for 5 so far in this call. I think that the worst idea for forward guidance were these dot plots.
I'm sorry?
The dot plots.
Oh God, yes.
And then we get the dot plots, and then the most ridiculous thing is you get Jay Powell on the podium after the FOMC meetings and he tells everybody, to ignore them. Well, then why are you doing them?
Yes.
And this was a construct of Ben Bernanke more than a decade ago, and I think it's been a dismal failure. And what happened this time around, back to Ira's point, was when you're going to make these dot plots, it's one thing for David Rosenberg or Ira to have our own dot plots, our own forecasts. We're not that public. We're not as public as Jay Powell is. And I would say that people look to Jay Powell for leadership, and people tend to believe, and I would say appropriately so, that the Fed has more information than the rest of us. I mean, if Jay Powell is calling any one of us or anybody in industry, who's not going to pick up that call? So you see what I'm saying here is that when the Fed unveiled its first forecast dot plot for the funds rate for the end of 2023. And they first unveiled that at the June meeting in 2021. Do you know what their median dot plot was for the end of this year? Do you know what it was? And this I'm not going back 10 years. I'm going back like to the summer of 2021. It was 0.625%. It was
I was
5.
going to say 0.5. Oh.
Yeah, 0.5%. That's so if you're planning, if you're a banker, you're in the mortgage market and the housing market, you're planning, you're financing, and you think, well, these guys know what they're talking about. They're the Fed after all. Look at them. Now we're going to finish the year over 5%, and every one of these people that were saying lower for longer, and there's no rate hikes coming of any significance for many years. Look at what's happened, and there's no accountability. Now look, I have accountability. So does Ira. I've got accountability to my clients. That's for sure. But I'm not a government official. They should be held to a higher standard. And so the dot plots just create this massive confusion. So of course, if you're Silicon Valley Bank or any bank, you're taking the Fed at its word. They're going to have tolerance for inflation. We all knew that cost push inflation was going to come. Transitory, beauty's in the eye of the beholder. What is 18 months in the overall annals of economic history? Is that transitory or over only in today's? I can't see past the tip of my nose, and I can't see the forest past the trees. In today's investment environment, where long term is lunch next week, what does transitory mean? I don't think the Fed was ever wrong on transitory, but the next thing you know, and it's a matter of hubris. They're so thoroughly ashamed and embarrassed. And then the temerity of being compared to Arthur Burns. I mean, who wants that in their epitaph? And so we're going to finish the year over 5% on the funds rate, which is amazing when you consider what their forecast was not even 2 years ago for the end of this year. And so it just seeds more confusion, and it sows the seeds for bad decision making. So the Fed, in my opinion, was complicit in this bad behavior. When you're telling the world that we're going to do this, and then we basically, in a very short period thereafter, play the role of Lucy and Charlie Brown on the football. And that's really what the story was. Not that there's not other excesses on bank balance sheets beyond just hold to maturity treasuries. There's other problems. We know that the commercial real estate in the regional banks is a big problem. It's a known problem. What's unknown is just how deep this problem is going to be at this stage.
Mhm.
But I tend to agree with Ira that the forward guidance. I say let's go back to the Greenspan days. I sort of liked it. I can't say I liked it when it was all a shroud of secrecy under Volcker. But Greenspan, I think, had it about right. Greenspan was the guy who unveiled actually the post-meeting press statements, just giving you enough information that you need and not more. And then the Fed has just gone overboard, and it started with Bernanke, just gone overboard. And I think it's just flown in everybody's face.
That's interesting. Your thoughts, Ira?
I can't agree more. And I'll, because I still bother to read the academic literature, I'll take it back to Michael Woodford's, work, which Bernanke relied upon but I agree with you. It was Bernanke who instituted this. It was a miserable, and I don't understand when these journalists, I said, let me into one of these press conferences. I have a few questions I would ask Jerome, because he is, as David rightly says, we've heard from him over and over again. The dot plots are terrible forecasters, and yet that's where everybody goes. So the Fed directs the media picks it up because it's the easy, you could put it in a headline. Fed dot plots say 4.5%, and they get and it's a lazy way to do this. And David, if I threw that stuff out, I'd be embarrassed. I'd be broke. If that was my forecasting ability, I would have been broke in this business 30 years ago, 35 years ago. But the problem with the Fed is not only is it a poor forecaster, but they make such gigantic bets on these forecasts. They made gigantic bets. Look we're only going back a year to when they ended QE. So the inflation transitory discussion, and they're still going to, they had started cutting it, but they were still adding reserves to the system. So it's the size of the bets that they make, and then they wonder how are they going to get out of this, and that to me is what causes the problem. So I can't agree with David more about it. I mean, and it is when Powell said in his recent congressional testimony, I'm not here to point fingers, you know, and my rabbinic remark was yes, because when you point the finger, there's three more pointing back at you. And they take no responsibility for it whatsoever.
Well, that's what we mean, you know, when people talked about Japanification, right? That, you know, it's the BOJ that started this road towards quantitative easing, and they've institutionalized their central bank balance sheet on the markets and on the economy. And I think to some extent, the rest of the world has followed suit, but including the US. And so, you know, here we had that expansion. It was the longest economic expansion, you know, I'm talking about, I mean, it took a while to get out of the gates from summer of 2009 to early 2020. Longest expansion, unemployment rate down to 3.5. You have Donald Trump, you know, boasting about how we have these record low unemployment rates for all these demographic groups. And of course, it was all him. We had tax cuts up the wazoo. And the Fed still couldn't get its balance sheet under $5 trillion. So, you know, what did we start when we started the great financial crisis, the Fed's balance sheet was like 800 billion, and it was just stuffed mostly with treasury bills. They weren't actually managers of duration and credit. And so we never got it under $5 trillion, you know, and that was in the longest economic expansion of all time. So here we've institutionalized and supposedly a bastion of capitalism. Most people don't understand how all this has happened, but I'll go a step further and say that it's not just the guidance. It's also the quality of the analysis. I've got to say that I really resent all these Fed officials tripping over themselves to talk to Bloomberg Radio, Bloomberg TV, Fox Business, CNBC. It's crazy. They're like basically they're like Hollywood actors. I've never seen anything like this, and they never say anything that's really very interesting except how they would cast their vote at the next meeting. It's unbelievable. And you know, I actually went back to show you what I do for fun. So I went back over the weekend because I'm writing a report on you know, what causes the Fed to pause. And so I went back to the, you know, we don't always have didn't always have these press statements. We didn't always have the press releases after the meeting. The minutes, you know, at a certain point in time didn't say a whole heck of a lot except the roll call for the vote. So you got to go to the transcripts. And, you know, when you go back and read the transcripts, and I'll tell you, whatever the view is about Alan Greenspan, far from perfect. We all know that. But when you go and read the transcripts of the Fed in the 80s and in the 90s, the intellectual heft is incredible, especially when you compare it to today's version of the central bank. And when you go and you read at the end, after everybody talks, and then Greenspan commands the room with his thoughts on the economy and the markets. You know, he might have blown the housing bubble. Of course, he had a lot of help along the way from the industry itself, housing and mortgages and politicians. Everybody was caught up in it, but the level of brilliance is incredible. So I'm just going back in time just to see what was the Fed looking at, because at some point they're going to pause. What is it that caused them to pause? Because it's not always a calamity. Just they see something that says, okay, enough is enough. So that's what I was looking at, the reports coming out this week. But it just reminded me of how eclectic and broad-minded I'm looking at what they're looking at historically is not what the Fed's looking at today. They're just so myopically focused on lagging and coincident indicators. You think the central bank would be focused on leading indicators of economic activity and leading indicators of inflation. They're all just so razor focused on lagging indicators to a point that I've never seen before. Of course, this is why we're going to end up with a policy mistake. This is why we're going to have a recession that a lot of people, you know, one of my predecessors who's still at Merrill Lynch, I see was quoted in the Investor Business Today saying, recession, smecession, you know, who cares if there's a recession? And it's the most widely advertised recession on record. Well, maybe that's true, but it's still not fully priced. It's not priced in with a price earnings multiple pressing against 19. That is not a recession multiple. And high yield spreads are not 450 basis points heading into a recession. So frankly, I don't give a damn about whether this is the most widely talked about recession of all time. Most asset prices and sectors of the stock market aren't more than halfway priced for it. And that's all I care about. But I'll just say about the Fed that it is very disappointing that in a matter of 18 months, we have the head of the Fed. What's he telling us, Ira, at the press statement, that when he was the nation's resident social worker, talking about how we're targeting minority unemployment rates, youth unemployment rates, female unemployment rates, and so basically, of course, you'd have a view that they're not going to do anything with rates maybe for many, many, many years. That wasn't like 5 years ago. That wasn't 3 years ago. He's the resident social worker of America. And look today, so we've gone from these unemployment rates for the hard hit in the demographic strata to what? To the newly minted core CPI, which is the ex-energy, ex-rent service sector. He's basically targeting 20%, focusing the attention, and it comes out of nowhere. New research by the Fed, they're focused on 20% of the index. That's what? Airlines, restaurants, hotel and accommodation, healthcare, education, ex-energy, ex-housing services, core services, core services, 20% of the index. That's what's driving policy right now. And everybody on Wall Street, they're like a bunch of lemmings. This is actually, look at the Fed, their new index. This is really something cool. No, it's ridiculous. They're throwing out the other 80% because they're consumed with the labor supply demand mismatch in these particular sectors of the economy. When did we last have the Fed focusing its attention solely on 20% of GDP? It's like saying, I'm just going to focus my attention on New York and California, and the rest of the country be damned. We're just focusing on 2 states. Again, I've never seen this before. Like, I know what it is they're looking at. It's just very difficult to come to grips with.
Mhm.
This is such a great discussion and a needed discussion, because it does call out the Fed. And I've been in my blog for the last 18 months, 2 years, whacking Mary daily, because if you listen to her, even Kashkari, who I would expect somewhat better from, but he's just a politician, they've been so wrong, and yet they get interviewed, and I go, why are they getting interviewed? Nobody brings up their poor records. She was so dovish until the ultimate end, and then now she flips, she's a hawk, and she can't even, she's at the San Francisco Fed, and she has the CEO of Silicon Valley on the board of the San Francisco Fed, Becker, and they never have a discussion about what's going on. What role is he serving there? It absolutely, I go, they should all be fired if there was any, as you talk about, accountability. Now she's just gone quiet because she's embarrassed at how bad this was, because this was on the San Francisco Fed as well. And yet she had the source of it on her board. What were they talking about? Yeah, I know. And you're rightfully, Powell during COVID and previous to that, even when he did his pivot, became the Minister of Social Justice. And I really had thought better of him, that he would take the bull by the horns. But it's not, of course, it's the politics that enters into it, because, and this is not a political statement, Donald Trump couldn't tolerate the two who I know who were in the running for that Fed chairmanship, which was Larry Lindsey, who I think we would both say we respect and is certainly in that intellectual, and Kevin Warsh, who's also, but they were too strong for Trump. There was no way that those two were going to become chairman, because he needed somebody he could put, and he tried to, and he did, was he successful pushing at Powell? We can argue that Powell tried to stand his ground, but the Fed bears so much of this responsibility, and they don't get a free pass, not for me, and certainly evidently not from David, and their forecasting has been so far off, that why would anybody, Wall Street likes to give them credibility because they're lazy and they want the easiest route possible. That's all I can say about it.
Yeah, David, just coming back to your views on the US dollar and the relation with gold forecast. What are your thoughts on emerging markets? And to what extent do your views on recession extend globally into emerging markets?
Well, the problem is that when the U.S. was in a recession, and the U.S. was into a recession bear market, the rest of the world, the emerging markets tend to underperform because the emerging markets are more cyclical and they're a high beta trade on global GDP. So, what you find is that when we're coming off the bottom of a cycle, emerging markets rip. That's where you want to be. You want to be in emerging markets in the first 5 innings of a cycle. The last 4 innings and then into the recession. No, I know people talk about, that there's a lot of value. Some of these markets trade with single-digit multiples. So you could argue there's valuation support. But when you're taking a look at the vagaries of the business cycle and you're taking a look at how these emerging markets in general thrive on liquidity, and liquidity tends to be more abundant in the early stages of a cycle, I would say better to wait until we get out of the recession into the early stages of the recovery. This will be some sort of a 2024 story. So I can't say valuations aside. I think Ira is allergic to this view. So
No.
but I think that if Peter Bookfar, our friend, was here, we talked about the valuation support, and I agree with that. That limits the downside. But if I had to be in any particular stock market for the next year, even though I don't like the U.S. stock market, I don't like stocks in general. In my personal account, I probably have the lowest share of equities that I've had since 2007, just for full disclosure. The U.S. market just has more defensive growth and less cyclicality to it, than in New Zealand or in Australia or Canada or most of emerging Asia. So I would say that, no, I'm not a big fan right now. Where we are in the cycle, heading into recession, I don't even know if there's a time period historically where emerging markets outperformed relative to developed world when the economy turns down. So I say be patient, and that's the trade you want to make heading into the next recovery.
And in the developed markets, could there be the potential for infrastructure boom on like trends of reshoring and green energy? So like in the US, Canada, Western Europe in particular?
Well, I think that that's a secular trend. And so that transcends the business cycle. Look, the greening of the world, absolutely. That plays into a lot of commodities as well, as we all know. That's an infrastructure is really a motherhood term that you amortize over at least 10 years. So you can invest, if you want to invest over the long term, say, and you want to ignore the vagaries of the business cycle, then you would want to focus on those forms of, say, basic materials, industrials, capital goods, even forms of technology and agricultural technology. So that's more how you want to play. You want to have some money in your portfolio that's playing the next 10 or 20 years. A lot of those opportunities, by the way, are more probably in alternatives than they are in the public markets. But I would tend to agree with you 100%. There's other areas, aerospace defense. You got pacifist countries like Japan expanding its military budget to an extent we've not seen in the post-World War II period. And in previous years, we'd be raising our eyebrows, but we know what it's all about. And it's all about China. And we also know what's happening in Germany, pacifist country, dramatically raising its military budget. We know the story there, and it's mostly about Russia. And the big concern, of course, is what happens in the next 3 or 4 years surrounding China and Taiwan. And China would take Taiwan by force. How would the U.S. response be? Big question marks. But all roads lead towards defense. Capital goods, defense capital goods. And the United States is the leader there, by the way. And so we've been on top of that for a couple of years now. That's what you want to invest in. You want to invest in areas that have visibility, that transcend the business cycle, don't have a large correlation to GDP. And so the areas you're talking about, infrastructure, the environment, climate, energy, that's not going away. And that's fund flows will be gravitated towards those areas. And I would throw aerospace defense in there as well. And I mentioned before, something very important, which is also farmland. Again, something or anything that touches food security and cybersecurity. Those are areas you can invest in for sure. For beyond, and that's what I've been saying is that it's not that I'm overly bearish on the equity market. Just be very mindful about where your exposures are within the equity market. The less cyclical, the better. The more thematic, long term, the more thematic, the better.
Mhm. Interesting insights. Your thoughts, Sarah?
Well, there's nothing I could disagree with there. And my bullish view on Japan is because, number one, I think because the currency is so weak and Japanese large multinational corporations, which are many and powerful around the world, are really, you see their R&D spending is ramping up, and especially, as David points out, in the defense sector. Now, I'm not a defense investor. That's my own view I'll invest in prostitutes, smoker. It's not like I'm a Calvinist. I'm not. I just, because my dislike of the defense budget process in the United States goes back to my university years back in the early 70s. So I stay away from but I'll invest in, I'll invest in all kinds of energy, but defense, but I see what's going on. David's 100% right. And defense spending and R&D is ramping up. It's ramping up in Japan, which is a whole new venue. And the Japanese and the Germans, when they move into these sectors, they have a lot of high level engineers. I mean, it's when they want to move, the world better sit up and take note, because they can make this shift so quick that the world's kind of not ready for it in their investing views. But this one makes me really, and I don't, when it comes to global macro stuff, very rarely do I agree with Warren Buffett, but I've been watching his move into Japan since early 2020, during COVID, when he started buying into the large Japanese trading companies. And he's done very, very well there. But I think there's plenty of room to run in Japan, especially because they're, for lack of a better word, onshoring things that, because of, number one, I think the weekend gives them a huge competitive advantage. The one area that I'm really interested in, and this is in your backyard, both Richard and David, is Canada. Because for all the things you talk about, farmland, they have some technological prowess. Why is Canada such a problem here? And I respect Mecklen, because he's got that Greenspan to him, where he's doing a cost benefit analysis and not just raising to raise. I know he's got issues with the housing market, and so much of that funding is tied on a short-term basis. But why is Canada struggling so, currency-wise and maybe otherwise?
I think that if you notice that the Bank of Canada has sat out the last two meetings, the Fed continues to raise rates, and the Bank of Canada's guidance is a little on the soft side. They're not indicating they're going to cut rates, but they don't seem to be in a hurry to raise rates as much as they do in the States. In the States, they're going to, looks like, we're 90% priced in for the May 3rd meeting, because the Fed has nudged the market in that direction. And then there's some residual probability they can go again in June. And just because I don't think they will, I don't think the data will let them. There's some people, that like Bullard and others that want to go in June. The Bank of Canada's on hold. Why? Why is that? Canada's the 51st state, and we speak better French, maybe even better English, maybe not, but very polite society. The thing is that the Canadian housing bubble was bigger than anything the US saw back in 05, 06, and 07. The housing bubble here, in terms of price, was unprecedented, one of the most acute in the entire world, and the same with debt. So when I was pounding my fist on the table when I was at Mother Merrill in 06 and 07, and I was saying bubble, 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 this is going to end badly, Canada's bubble and housing and household debt is even worse. Every measure. So on top of that, a lot of the mortgage debt in the United States, got locked in at the lows of yield. And in Canada, people just went crazy. Canada was always historically a very conservative country, take out 5-year terms on mortgages. There are no 30-year mortgages in Canada, but people take out the longest term, which is 5 years. Now everybody took out variable rate mortgages the past few years. Everybody believed the central banker. They're on hold. Why would I want to lock in? So and then all of a sudden, Bank Canada takes rates up 400 basis points. So the reaction function in Canada to the higher rates in terms of housing and debt service impairment on household spending has happened a lot more quickly here in Canada. And so that's been a very big part of it. I think as well, a global investor is going to look at Canada and wonder, like, look what's happening on the fiscal side. Now, we can argue, as we did, about the US and the fiscal problems in the United States. But the United States does have the world's largest army. It is the world's wealthiest economy. And that's the reserve currency. Canada is none of those. Canada seems to think it can just run a fiscal situation as if it's the United States. Canada's not the United States. The fiscal situation, when you count on the provinces and the federal government, is the spending, Ira, is out of control. There is nothing to promote. It's one thing to have people will say, oh, well, look, the deficits aren't that high, but we're at full employment. We're like 5% unemployment. Where do the deficits go in the next recession? There's been no move to try and attain in Canada anything remotely close to fiscal sustainability. And so on top of that, look where the spending initiatives have come. There's nothing from the federal government in Canada to promote capital formation. You know, what's interesting is people look at Canada, what a country, what a miracle. Canada's letting in 1 million immigrants per year. And so all the growth in the economy, like basically population growth, even with record low fertility and birth rates, population growth in Canada is 2%. I think 2% growth in population. And so when people say, oh, well, look at the Canadian economy, it's 2% stable growth. Yeah, no, actually, per capita, it's flat. In per capita terms, the Canadian economy is flat to declining. And the government has spent so much time trying to promote social spending and trying to promote housing, which is a non-productive asset. There's been no growth in the productive private sector capital stock in Canada in a decade. And that's showing through right now in declining multi-factor productivity. So I live in Canada. I think as a society, it's stellar. As an economy and government policy, it needs to change. You're going to turn bullish on the Canadian dollar outside of terms of trade. You can say, I'm going to trade the Canadian dollar like I'll trade the oil price. Fine. I would just say trade the oil price. There's a lot of structural underpinnings in Canada that need to turn around before I turn bullish on the loonie. That's for sure.
Yeah, totally agree. Yeah.
So, but I mean, the one issue I never understood was with Trudeau, when Germany came begging for oil and gas because they were looking for, and he basically shut that off. I didn't understand that. I don't care what your outlook is for where we're going to go with clean energy, but you've got lots of energy. The world is craving for it because Germany's burning more coal now than anything. So you should have been selling it and using the proceeds from the massive amount of energy that you could sell to the world to then elevate some of your more green technology initiatives. Why aren't you, he had no view to that. It was like, oh, well, if we don't sell it, nobody's going to buy anything.
Well, it's even more than that. In Canada, there's also all sorts of territorial issues and there's provincial issues that have been, that stood in the way of shipping especially the gas and the oil out of the country. So you're 100% right, but it's not even just the federal government, but also the provincial government and also, other areas that are obstacles that I'll get into trouble if I talk about in public, but there's all sorts of impediments that are standing in the way. But let's talk about, you mentioned Japan. By the way, we're about to publish a report on Japan. I totally agree with you on Japan. We have been bullish. We're turning more bullish. We're actually going to publish a report on it, Ira. And on top of that, though, there's two other countries. There's we talked about emerging markets. I'll tell you one market in emerging markets that we really like, and it's India.
India?
Notwithstanding, not like there's of course we know Modi is a strong leader, but very divisive. We know about income inequality and poverty, but Gesundheit again. But the reality is that they have a vibrant, a young population. They are the antithesis of China. They are where China was 20 years ago. And they're spending a lot of money on infrastructure, which is what they need. So I look at India as, again, if you're looking for regional exposure, in a market that is liquid, it is an emerging market, but it has, I think, secular long-term growth dynamics that aren't fully appreciated. And I would throw in there, because somebody mentioned friendshoring or offshoring, that Mexico is a big beneficiary of this trend towards tweaking global supply chains. And people say, oh, well, but it's not as cheap. People still play that card, but it's not as cheap as Asia. Manufacturing costs are higher in Mexico than they are in most of Asia. However, think of for U.S. business what happens to transportation costs, because they're a lot lower. And so this is actually a big win for Mexico. I don't know why this wasn't realized before. Of course, there's always question marks over Mexico's electricity grid and that reliability. But Mexico comes out of this a pretty big winner too, and something that should be on our radar screens. I would say that's what I'm saying is that being a Canadian, it pains me to say it, but I think I'm more focused on our NAFTA amigo to the south than our
Me too.
our ami to the north.
Yeah. Excellent. And any final thoughts, Ira, also?
And I totally agree with that. In fact, it was one of the few things to me that Buffett missed, because in my 3-4 years ago, I was very bullish Kansas Southern, because it was the direct route from the heartland down into Mexico. Because as Trump started talking up the tariffs on China and some of the animosity was building, I said, well, Mexico was a great story that never could happen, because the Chinese depreciated the currency on the day that NAFTA started in January 1st, 1994. So the yuan devalued from 5.8 to 8.7, which basically sold the thunder out from Mexico. But Mexico, because of the dynamics of the geopolitical situation, was, and of course, Canada Pacific wound up buying Kansas Southern. I mean, certainly at an elevated price, but it gives them that access right down the spine of the United States into Mexico, and where all the factories and maquiladoras are. So I agree with you wholeheartedly. I also wanted, if we go back and look at at central bank policy, everyone likes to talk about Jackson Hole. Well, Greenspan, and I have a lot of respect for Greenspan too, not like I do for Volcker in different ways, but Greenspan gave a speech in Jackson Hole in 2003 talking about how the best Fed policy is basically a cost-benefit analysis. We don't get any of that. And I will say this, I think the Canadian Central Bank is, for different reasons, more oriented towards some cost-benefit, as the Bank of England is. When I read the tea leaves going into the meeting on May 3rd, I would expect a vote of 8-4. I would see 4 dissenters at the Fed. I would see Lisa Cook, who's actually wrote a speech last week I thought was really good, and she actually stepped out. I think Austin Goolsbee won't be steamrolled like others. I think his ego is
true.
such.
Yeah, he's I like Austin a lot.
Yeah, I agree.
Yeah, out of all of them, actually, I tell you that he makes the most sense to me, and it's not anything to do with the fact that we necessarily are on the same page. It's just that he's actually got a thought process.
Yeah, I agree.
It's not just basically, cameras are rolling, how you casting your vote at the next meeting. So I totally agree with you on that.
Yeah,
And
I would add one more, Lori Logan, to that list. I think she, coming out of SOMA, and running the Fed trade. Now that she's head of the Dallas Fed and she's a voting member, she writes, she knows what's going on. So I'm waiting for them to stand up a little bit and push back, because I think that a split vote would tell me more than anything.
Well, let me just say that you realize that when in early 2018, when Powell got appointed and confirmed as Fed chairman, everybody was telling me it's about time we got the economists out of running the Fed. It's about time we pushed the economists to the side. To which I said, well, is it better to have a lawyer? I mean, because the old story, right? The old story is, well, what do you call an economist and a lawyer at the bottom of the sea? A good start.
No. Okay. Okay. Well, it's been a great discussion, awesome insights. David, how can our listeners and viewers learn more about your work?
Great. Well, you just can go onto the Rosenberg Research website and click on, or you can just go to information@rosenbergresearch.com, or you can just email me directly, drosenberg@rosenbergresearch.com. And we have a 1-month free trial. So please come and kick our tires and taste our wares. We have a free one month trial of everything that we do.
Yeah, awesome. Yeah, and we'll put up the links and contact info.
Thank you.
And Ira?
You know what? I really haven't been writing much lately because it's the same tired stuff, but with the holidays setting. But I wrote a piece last night and generate some thought, but mostly doing these podcasts. I mean, to be able to sit with Richard and you and David Rosenberg. I mean, this is great because we actually get to discuss in depth. Where I know if David goes out on Bloomberg or depending upon who he's on with, or CNBC, and I don't think you do that. Well, I don't watch like I used to, but these you get to discuss in depth, and I think these in-depth discussions are really good. So I hope to do more and more of these. I think that they're really good.
Yes. Thank you so much, David and Ira. Thank you.
Well, you as well. That was I know we had a good time, Ira, because the hour went by quickly.
Kind of like my marriage. Okay. Thank you. This was great, and look forward to more of
Richard.
Thank you.
Thanks very much, Richard. This was really great. Great venue. Thank you very much.
Yep. Thank you.
Yep.
The FRA Roundtable Insight Show is for informational and educational purposes only, and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.